The United States printed trillions of dollars. That's not conspiracy. That's not speculation. That's not some guy in a basement with a whiteboard and red string connecting dots on a corkboard. That's public information sitting right there on the Federal Reserve's balance sheet for anyone with an internet connection to read. Trillions during the 2008 financial crisis. Trillions. During COVID, trillions more. Quantitative easing, round 1, round 2, round 3. Emergency lending facilities, stimulus packages, special purpose vehicles, trillions upon trillions upon trillions. More dollars created in the last 15 years than in the entire previous history of the United States combined. And here's the thing that should genuinely keep you up at night. After all that printing, after flooding the world with more dollars than have ever existed in human history, America didn't collapse into hyperinflation. Prices went up, sure, especially after 2020. And people felt it at the grocery store, at the gas pump, in their rent checks, in their insurance premiums. But the apocalypse didn't happen. No wheelbarrows full of cash to buy a loaf of bread. No Weimar Germany. No Zimbabwe. No Venezuela. The system held. How? Why? Because most of those dollars don't live in America. They live overseas. They're scattered across the entire planet. In central bank vaults in Tokyo and Beijing and Riyadh. In offshore accounts in the Cayman Islands and Luxembourg and the Channel Islands. In oil trades in the Persian Gulf. In debt payments in Istanbul and Buenos Aires and Jakarta. The dollars are out there working, circulating, being useful, lubricating the gears of global commerce, just not inside the United States. And as long as they stay out there, everything holds together. The machine runs, the music plays, everyone keeps dancing. But if those dollars come home, and there are real growing concrete accelerating reasons to think they might, that's when the math breaks. That's when inflation explodes. That's when markets overheat. That's when the whole arrangement, this extraordinary, improbable, decades-old arrangement, starts to crack. The United States doesn't just prefer that dollars stay abroad. It needs them to stay abroad. Its entire financial architecture, its trade policy, its foreign policy, its military posture, all of it is to a significant degree organized around one quiet imperative. Keep the dollars out there. So, let's talk about where these dollars actually are, why they're there, what keeps them there, and what happens if they start coming back. The dollar is not just America's national currency. It's the operating system of the global economy. When Saudi Arabia sells oil to Japan, the deal is priced and settled in dollars. Neither country is the United States. Neither country uses the dollar domestically, but the transaction runs on dollars anyway. When a Brazilian company borrows money on international capital markets, the loan is almost certainly denominated in dollars. When the central bank of South Korea or India or Poland builds up foreign exchange reserves for a rainy day, for a crisis, for stability, they buy dollars in U.S. Treasury bonds. When a Nigerian businessman moves money offshore. When a Russian oligarch parks wealth in a shell company. When a Chinese manufacturer invoices a European buyer. Dollars, 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 always dollars. The scale of this phenomenon is genuinely hard to comprehend. Somewhere between 40 and 70% of all physical U.S. currency, the actual green paper bills, circulates outside the United States. Hundreds of billions in cash stuffed in the safes and mattresses and vaults from Moscow to Mogadishu. Dollar reserves held by foreign central banks run into the trillions. Dollar-denominated debts owed by companies and governments outside America. Trillions more. And then there's the euro-dollar market, which most people have never heard of, but which dwarfs almost everything else in the financial system. Euro. Dollars aren't European currency. The name is a historical artifact deeply misleading. They're U.S. dollars held in bank accounts outside the United States and banks beyond the direct reach of the Federal Reserve and American regulators. London, Singapore, Hong Kong, Zurich, the Caribbean. An enormous, sprawling, largely invisible network of financial institutions taking dollar deposits, making dollar loans, creating dollar credit, all outside America's regulatory perimeter. This is the dollar's external circuit, its shadow empire, its second life. Tens of trillions of dollars that America created that bear America's name and America's promise, but that America doesn't directly control, can't directly control, doesn't even fully understand the scale of now. The obvious question. If there are so many dollars living abroad, why don't they come flooding back? Why does Japan's central bank keep holding over $1 trillion in reserves instead of dumping them? Why does China keep buying treasuries, or at least hold on to the ones it has? Why do companies in emerging markets keep borrowing in dollars when their own governments tell them it's risky, when their own experience tells them currency mismatches can be fatal? The answer is deceptively simple and deeply structural. The world needs dollars, and there's nothing else that does the same job. Not yet. Not fully. Not even close. Dollars are needed for trade. oil, natural gas, copper, iron, ore, aluminum, wheat, soybeans. Most global commodity markets still operate in dollars. This didn't happen by accident. This didn't happen because dollars are inherently better for buying oil than euros or yen. It's the result of decades of deliberate American policy, especially the deal struck with Saudi Arabia in the 1970s. The Saudis would price oil exclusively in dollars, and in return, America would guarantee their security, their regime, their place at the table. That arrangement, the petrodollar system, anchored the dollar at the heart of global energy markets. And energy is the foundation of everything. Every factory, every farm, every truck, every airplane runs on energy. If your country needs oil, and every country needs oil, you need dollars. Period. Full stop. No negotiation. Dollars are needed for debt. An enormous share of international lending is dollar-denominated. If you're a Turkish corporation with a dollar loan, you need dollars to make your interest payments, your principal payments. You have to earn them through exports or buy them on the foreign exchange market. That creates constant structural mechanical demand for dollars that has absolutely nothing to do with whether Turkey likes America's foreign policy or admires its culture. It's automatic. It's relentless. And it's inescapable. As long as the debt exists, the dollar demand exists. And frankly, dollars are simply more attractive than the alternatives. The dollar is the most liquid currency on Earth. You can convert it to anything, anywhere, anytime, in any amount. Treasury bonds are considered the safest asset in existence. The risk-free rate, the benchmark against which every other asset on the planet is measured. Even when yields are low, even when the national debt is terrifying, even when there are real doubts, what else are you going to hold? Euros backed by 20 different governments that can barely agree on agricultural subsidies, let alone fiscal policy. Yuan, which China won't let you freely convert and could freeze or manipulate at will. Gold, which pays no interest, is expensive to store and practically impossible to use for large-scale international transactions. The dollar wins not because it's perfect, not because it's trustworthy in some absolute sense, but because everything else is worse. It's the cleanest, dirty shirt in the laundry basket, the least ugly option at a very ugly party. All of this creates massive, persistent structural global demand for dollars. The world wants them. The world needs them. The world hoards them. And that right there is the foundation of everything. Here's where it gets really interesting. Because this arrangement, the world holding trillions of American dollars outside American borders, is not just convenient for the United States. It's not just a nice-to-have, a pleasant bonus, a cherry on top of American prosperity. It's the foundation of American economic power, the hidden engine of American dominance, and simultaneously the single greatest vulnerability in the entire system. When the world holds dollars, especially in the form of treasury bonds, it is directly, literally, mechanically financing the American budget deficit. Let that sink in. America spends more than it collects in taxes every single year. Not occasionally, not in emergencies. Every year, year after year, decade after decade, under Republicans and Democrats alike. The difference? Hundreds of billions. Sometimes well over $1 trillion per year is covered by issuing treasury bonds, government IUS. And who buys those IUs? The world. China, Japan, Saudi Arabia, European pension funds, Asian central banks, sovereign wealth funds from Abu Dhabi to Singapore. They give America real things, real goods, real resources, real labor, real commodities. And in return, they get a promise. A promise from America to pay them back someday with interest in dollars. Dollars that America itself prints. Think about that for a moment. Really think about it. This is what the French once called the exorbitant privilege. The phrase coined by Valéry Giscard in the 1960s when France was already frustrated with this arrangement. America gets to live beyond its means permanently structurally by design, because the rest of the world voluntarily, though not always happily, lends it the difference, not out of charity, not out of admiration, but because the system is built so that they have no practical alternative. And there's a bonus, maybe the most important one of all. As long as dollars circulate abroad, the inflationary impact of printing them is diluted across the entire planet. The Fed creates trillions. But those trillions don't all stay in America, competing for American goods and services, pushing up American prices. They disperse globally, flowing to every corner of the world where dollars are used. Prices rise, but they rise everywhere. A little bit in Tokyo, a little bit in São Paulo, a little bit in Lagos, a little bit in Berlin. The inflation tax gets exported, distributed, shared with 8 billion people, whether they signed up for it or not. As long as the dollar is overseas, inflation isn't entirely at home. Or more accurately, not all of it is at home. Now, let's talk about what it actually means mechanically. When dollars come back, not as an abstraction, not as a theoretical exercise, as a concrete chain of events. Imagine China decides to significantly reduce its dollar reserves. It starts selling treasury bonds in large volumes. Supply of bonds on the market increases, prices drop, yields rise, which means the interest rate that the US government has to pay on its debt goes up. Borrowing suddenly costs more. The deficit widens because interest payments balloon. Meanwhile, China now holds dollars from the bond sales. It converts them to yuan or buys gold or buys European assets or invests in African infrastructure. But those dollars don't vanish into thin air. They end up with whoever sold China, the gold or the assets. Those people or institutions now hold dollars and need to do something with them. The dollars keep circulating looking for a home. Now imagine it's not just China. Saudi Arabia starts accepting yuan for oil. They've already begun in small amounts. India settles trade with Russia in rupees. Brazil and Argentina discuss bilateral trade in local currencies. ASEAN nations explore regional settlement mechanisms that bypass the dollar entirely. Russia, already cut off from the dollar system by sanctions, has rebuilt its trade around yuan and other alternatives. Each of these shifts is small on its own, but collectively, they represent a world that needs fewer dollars, and dollars that aren't needed abroad come home. Where do they go? Into American markets. Foreign holders looking to deploy their unwanted dollars. Buy American stocks, bonds, real estate, farmland, companies. Dollars flood back into the domestic economy. Liquidity surges, and then the problems begin in earnest. Prices rise because there's too much money chasing the same amount of goods and services. Markets overheat because all that returning capital needs somewhere to go and inflates bubbles in equities, real estate, anything with a price tag and a ticker symbol. And confidence erodus. Because when the rest of the world visibly publicly stops wanting your currency, people inside the country start asking questions they never asked before. If foreigners don't want dollars, should I? This isn't hypothetical. We've seen versions of this play out before, each one a warning shot. In the 1970s, when OPEC quadrupled oil prices and the flows of petrodollars shifted and slashed, America got hit with an inflationary shock that lasted nearly a decade. Double-digit inflation, stagflation, the previously impossible combination of rising prices and rising unemployment. Fed Chair Paul Volcker had to crank interest rates all the way up to 20%, deliberately engineering a devastating recession to break the inflationary fever. People lost homes, businesses, livelihoods, savings. And it started fundamentally with a shift in how dollars moved around the world, with a change in who held them and on what terms. In 2008, the opposite happened. A global flight to safety drove dollars into America, into treasuries, into anything perceived as a safe haven. But the flood of liquidity the Fed created to fight the crisis. Quantitative easing, zero interest rates, emergency facilities didn't flow into wages or factory floors or small business expansion. It flowed into financial assets, stocks, corporate bonds, real estate, and major metros. The S&P 500 began a historic bull run while median household income stagnated for years. Wall Street celebrated record profits while Main Street struggled to recover. The money came in, but it distributed grotesquely unevenly, pooling at the top, inflating assets that the wealthy own, doing almost nothing for everyone else. And then 2020 through 2022, the most vivid, most recent, most instructive example, the government injected trillions directly into the economy. Stimulus checks mailed to households, enhanced unemployment benefits, PPP loans for businesses, direct payments to individuals. The Fed created money at a pace that made its 2008 response look timid. And this time, the money didn't just flow into financial assets. It went straight into people's bank accounts, and they spent it. Demand surged while supply chains were still broken by CO shutdowns. Too many dollars chasing too few goods. The textbook definition of inflation playing out in real time. Inflation hit levels not seen in 40 years. 8%, 9% numbers that seemed impossible in the pre-COVID world of 2% targets and forward guidance. And here's the crucial point. Those weren't even dollars coming back from abroad. Those were brand new dollars, freshly created and injected domestically. Now imagine what happens when trillions of returning foreign dollars get added to that equation. America is not passive about any of this. The entire architecture of the global financial system, the institutions, the rules, the incentives, the threats is built, maintained, and aggressively defended to keep dollars abroad, to keep the world needing them to make their return inconvenient, expensive, frightening, or simply unthinkable. Sanctions are the most visible weapon in this arsenal. When America freezes a country's dollar assets, as it did with Russian central bank reserves in 2022, with Iranian assets, with Venezuelan gold, with Afghan government funds. It simultaneously punishes the target and sends a message to everyone watching. Your dollars are safe as long as you play by our rules. Step out of line, and we can reach into your vault from 6,000 m away and turn your wealth into zeros. It's extraordinarily powerful. It's also extraordinarily dangerous because every time America weaponizes the dollar, it gives every other country on Earth a reason to diversify away from it, to build alternatives, to reduce dependence. The sanctions weapon works, but each use dulls the blade a little more and sharpens the motivation to find workarounds. Dollar-priced commodity trade is another anchor, deeply embedded in the infrastructure of global commerce. As long as oil, gas, copper, wheat, and 100 other essential commodities are priced and settled in dollars, every importing country on Earth must maintain dollar reserves. No dollars, no energy, no economy. This is on a market outcome. It's structural dependency built into the plumbing of world trade over decades of deliberate policy choices. Dollar debts in developing countries are a third anchor. Less visible, but devastatingly effective. Dozens of nations, Turkey, Argentina, Nigeria, Pakistan, Egypt, Sri Lanka, and many more carry enormous debts denominated in dollars. They must earn or purchase dollars to service those debts. This creates permanent, inescapable, non-negotiable demand for dollars, regardless of how those countries feel about America. They can denounce dollar hegemony at every international conference, vote against America at the United Nations, sign joint declarations with China about a new multipolar order, and then go home and desperately acquire dollars because without them, they default, their credit rating collapses, and they're locked out of international capital markets. And finally, the gravitational pull of American capital markets themselves. The U.S. stock market is the largest, deepest, most liquid, most dynamic in the world. The technology companies defining the 21st century, Apple, Microsoft, Google, Amazon, Nvidia, Meta, all trade on American exchanges. Silicon Valley's venture capital ecosystem has no equivalent anywhere on the planet. New York, Miami, Los Angeles, real estate acts as a global wealth magnet, attracting capital from every continent. This pulls dollars toward America, but critically it pulls them into assets, not into the consumer economy. As long as returning dollars get parked in Apple stock or a penthouse in Manhattan, they're not buying groceries and gasoline. They're not creating the kind of street-level inflation that destabilizes societies and ends political careers. That's a subtle but absolutely critical distinction, and one that could collapse if asset markets crash and that wealth suddenly tries to move into real goods. But all these walls can crack, and the forces pushing against them are growing stronger, more coordinated, and more determined. Loss of confidence in treasury bonds. The most direct, most dangerous scenario if major holders conclude that lending to the U.S. government at current rates is no longer worth the risk. Because the debt is too high, because inflation keeps eroding real returns, because political dysfunction in Washington makes even the idea of default thinkable. Selling begins, bond prices fall, yields spike, borrowing costs for the government surge. The deficit explodes because interest payments balloon. More bonds must be issued to cover the bigger deficit. Fewer buyers step up because confidence is falling. A doom loop that feeds on itself and accelerates. De-dollarization is already underway. The dollar's share of global foreign exchange reserves has declined from over 70% 2 decades ago to roughly 58% today. That's a slow trend, but it's persistent, consistent, and very in recent years accelerating. Central banks are diversifying into euros, yuan, Australian dollars, Canadian dollars, and above all, gold. Gold purchases by central banks hit record levels in 2022 and 2023. These institutions aren't buying gold because they think civilization is ending. They're buying it because they want reserves that no one can freeze, no one can sanction, no one can print more of. Every percentage point the dollar loses in global reserves represents billions that either find another home or come back to America. Alternative payment systems are multiplying faster than most Americans realize. China's CIP system handles growing volumes of international UN transactions. Russia's SBFS replaced SWIFT for domestic and some international payments after sanctions. India's UPI system is expanding internationally. The BRICS nations are actively discussing common settlement mechanisms and possibly a shared currency unit. SWIFT itself, the backbone of international payments, lost its perceived neutrality forever when it was weaponized against Russia. Now, Every country that might conceivably find itself crosswise with American foreign policy has a powerful incentive to build alternatives. Each alternative transaction system, each bilateral currency swap agreement, each commodity contract settled in yuan or rupees instead of dollars. Each one is a small crack in the wall, individually trivial, collectively transformative, and a major geopolitical shock could accelerate everything overnight. A conflict over Taiwan that forces countries to choose sides. A fracturing of European consensus that weakens the euro and reshuffles alliances. A major Middle Eastern war that disrupts energy markets and trade routes. Any event that rewrites the map of who trusts whom could trigger a rapid, disorderly reassessment of dollar holdings worldwide. Here's the uncomfortable truth that ties all of this together. America doesn't fear a weak dollar. A weak dollar boosts exports, helps manufacturers, makes American goods competitive globally. America doesn't particularly fear a strong dollar. It creates problems for exporters, but attracts investment. America doesn't even fear the dollar gradually, slowly over decades, sharing its reserve status with other currencies. That's a manageable transition, a gentle decline that can be accommodated. What America fears is something far more specific and far more dangerous. Too many dollars inside America all at once. A tsunami of returning liquidity that overwhelms the domestic economy, that sends prices spiraling, that makes the post-COVID inflation look like a rehearsal. The trillions scattered across the world right now in central bank reserves and offshore accounts and commodity markets, in emerging market debt chains in the euro-dollar shadow system. Those trillions are simultaneously America's greatest asset and its greatest vulnerability. They finance the deficit. They suppress domestic inflation. They sustain demand for treasuries. They underwrite the exorbitant privilege. But there are also, every single one of them, a loaded weapon pointed at the American economy, held in the hands of foreign governments, foreign central banks, and foreign investors who may not always share America's interests, America's priorities, or America's timeline. The problem with the dollar isn't that it might disappear. The dollar isn't going anywhere tomorrow or next year or probably next decade. It's too deeply embedded, too widely used, too structurally essential to too many people and institutions. The problem with the dollar is that it might come home, all of it, at once. And nobody, not the Fed, not the Treasury, not Congress, not Wall Street, has a plan for that, because the whole system was built on the assumption that it never,